Markets are holding firm today with tech leading again. And Powell opened the door, at least reminded people that rate cuts are actually still on the table by the end of the year. So there's a little bit of momentum building in the markets. Get today's full trade setup and in-depth analysis at marketscholars.com with the link down in the description below or in the pinned comment. The S&P 500 finished flat on the day, but that masked some pretty major moves underneath the surface here. But just looking at the S&P, after a strong open, the index faded into the close and finished just a smidgen above the break-even point. More importantly, we're seeing repeated signs of divergence, right, where there's prices holding up here above highs and new 4-week highs, but we're getting thinner and thinner participation. And here is where that shows up pretty clearly, with tech leading the day again, up almost a percentage point there. But look at the other side. You have real estate, you have utilities and staples all down more than 1%. So not surprisingly, dividend ETFs like SCHD and DVY also sold off pretty sharply, down more than 1%, signaling some pressure on these yield-sensitive areas and defensive areas. The Nasdaq continued to outperform, lifted by Nvidia getting to new highs and other AI names, while small cap stocks lagged behind it. They actually dropped more than 1% today. It's a pretty widening spread between growth and value. You can see that here with the index closing up to its highest point that it's ever had on the ratio chart. So even with the S&P or the Nasdaq relatively flat, the market tone was clearly risk on, but very narrow. Meanwhile, Powell's comments from his 2-day testimony and second day of his testimony to Congress, this time before the Senate, adding a little bit of fuel to the fire. He hinted at some flexibility on rates. Again, just reminding people that those rate cuts are actually still on the table. And that sent the 10-year yield lower intraday, closing, bouncing a little bit after close, but closing right at the break-even point, pretty much flat. I mean, exactly flat, 4.29% on the day. As a result, too, the VIX dropped a third straight day. So 3 straight days of strong losses, or bigger losses, on the volatility index. So while the index may look calm, there's a lot of shifting going on underneath the surface, has been now for multiple weeks here, including today. So that's exactly why we track this. We track sector rotation, we track intermarket analysis in the full video every single day. If you're finding these insights helpful, don't forget to like the video down below, subscribe to the channel, and share this with other traders who might find this daily market outlook helpful to their routines. Now let's go a level deeper, because even though the index looks stable, the market internals are sending a different message. And we'll take a look here at this comparison chart of the equal weighted, the S&P 500 itself compared to its equal weighted version, RSP. And what we're seeing here with this nice trend and then a big breakout higher is some classic narrowing breadth. That's what this, I mean, look at the expansion of these moving averages. While the S&P itself continues, S&P 500 continues to hover near highs, getting really close to its highs, the equal weight index has been slipping, showing that fewer stocks are actually participating in this move. So the gap between RSP and SPY has widened pretty significantly over the past really couple of months here. And it's not just equal weight underperformance. Breadth indicators themselves are breaking down. The number of stocks trading above their 50-day moving average has fallen below the moving average again. So it's not down below 300, yes, so not a huge breakdown, but is below a relatively elevated 20-day average of these numbers. So this divergence between price and participation, you could say, is like a flashing yellow light at the traffic light intersection. So tech continues to lead, of course, but the other side of that trade is the breakdown in dividend and value strategy. You can see the Schwab U.S. Dividend Equity ETF closing lower today, breaking below the 17 and the 30-day moving average. Still holding above the 50, but that's a pretty significant breakdown there. So this isn't just like a rotation into some small gains and small losses here and there. This is a rejection right now of anything that's yield sensitive. Real estate down here at the bottom, utilities and staples were all hit pretty hard. 2.5% on real estate, 1.3 on utilities, 1.3 on staples. These are your typical defensive strategies. Healthcare too, but that's can be both, right? Cyclical and defensive. But these three especially are defensive sectors. And when they sell off on a day when the market's flat, that's a signal that capital is getting a lot more selective. So the takeaway, the market's still bullish, but the leadership is shrinking really fast, and that usually doesn't last very long. If you want to see our trade idea that we did today, as well as a deeper dive into a lot of these topics I brought up in the preview, I break all that down in today's market outlook video, along with more charts and macro insights and strategies behind the trade idea that we placed. It's available now for all of our foundation members at just $29 a month. So head over to marketscholars.com. Remember, the link is down in the description and the pinned comment below. Thank you very much for watching, everybody, and we'll see you all tomorrow.